Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Costco Wholesale Corp.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Absolutely, it really helps the channel out.
And just real quick before we get into the wealth building thesis for today, check out the link in the description for a 14-day free trial to StockOracle. It's the platform we use for all our research.
Yeah, it's a great tool. Just a quick affiliate disclosure, we do get a small commission if you sign up through that link, which supports what we do here.
Exactly. But keep in mind, any AI insights or value estimates we discuss from the platform, they could be wrong. You should always verify the data yourself. We're just here to talk through the research, not give financial advice.
Right. Definitely do your own due diligence.
Okay, so let's get into this deep dive, because we are looking at a snapshot of Costco as of August 20th, 2026. And the setup here is, it's honestly a glaring market mystery.
It really is. It's one of the strangest disconnects I've seen in a while.
Right. Because just in July alone, Costco sold over $23 billion of merchandise. That's a 10.7% jump year over year.
Huge numbers.
They are pulling in more cash, expanding faster, and reporting higher net income than ever before. So why has the market decided over the last 13 weeks to wipe nearly 15% off the value of their stock?
It's a paradox, right? Our mission today is to figure out how a business can be fundamentally accelerating while the market is basically treating it like a falling knife.
Exactly. I'm always looking at this from a capital protection standpoint. Is the market seeing a hidden storm, or is this just a massive generational opportunity for long-term compounding?
Well, let's unpack this.
Yeah.
Because the divergence between the actual business engine and the stock chart is it's jarring.
Very. I mean, the stock's currently trading at $933.51.
Right.
That puts it roughly 14.9% below its 52-week high, which was almost 1,097. But then you look at the underlying fundamental.
And they're pristine.
Yeah. Year-to-date revenue is $207.4 billion. That's up 9.7%. Net income is $6.2 billion, which is up 13.5%. And their operating cash flow, that spiked 17.6% to $11.1 billion.
Those are incredibly strong wealth-building metrics.
But wait, the net income is growing faster than the revenue. How does that even happen for a company that, sells bulk groceries and paper towels?
So that happens because their operating leverage is really kicking in. To understand how crucial that is for long-term durable growth, you have to think about how Costco functions on a physical level.
Okay, walk me through that.
Well, they're fixed costs. Things like warehouse rent, lighting, property taxes, baseline salaries, those are generally stable. So because those heavy expenses are already covered by their baseline sales, every extra dollar of revenue they bring in beyond that point, it doesn't cost them nearly as much to generate.
Oh, I see. So it just falls straight to the bottom line.
Almost entirely as pure profit, yeah.
Yeah.
So despite, lingering inflation or supply chain pressures, they are becoming highly efficient at turning top-line sales into actual cash in the bank.
Which is great for compounding shareholder value. But wait, if they're squeezing more profit out of every dollar and growing cash flow by nearly 18%, why the massive sell-off?
The market usually rewards that kind of operational efficiency, right?
You'd think so.
It just makes no sense to punish a company that is actively getting better at making money.
Well, it makes no sense if you look at Costco in a vacuum. But we have to pull back and look at the whole industry. This sell-off isn't necessarily a referendum on Costco's internal operations.
It's a macro thing.
Exactly. It's a reaction to the broader retail environment. Walmart recently issued some very cautious forward guidance regarding consumer spending.
Ah, right. And when the biggest retailer in the world flashes a warning sign that the consumer is tapped out, the market it shoots first and asks questions later.
Exactly. They assume if Walmart is bleeding, everyone is bleeding. Institutional investors look at Walmart's data as a proxy for the whole U.S. consumer base.
So they're assuming credit card balances are too high, savings are gone, that sort of thing. Right. The theory goes that if the consumer collapses, retail collapses. So portfolio managers are just liquidating retail stocks across the board to reduce exposure. Costco is simply getting dragged down in that macroeconomic undertow.
That makes sense on a macro level, sure. But, if Walmart is flashing these warning signs about broke consumers, how is Costco dodging that bullet? Because those July numbers show they clearly aren't slowing down.
No, they aren't.
Is it just because groceries are essential?
It's not just the products. It is the fundamental structure of their business quality. Their competitive moat is radically different from Walmart or Target.
How so?
Well, most retailers operate on a traditional buy low, sell high strategy. right? Their profit is baked directly into the markup on the shelf.
Right, standard retail.
But Costco intentionally buys low and sells low. Their gross margin is capped around 12.88%, and their net margin is a razor-thin 3.01%.
Which, honestly, that sounds absolutely terrifying from a capital protection standpoint. A 3% net margin means if your supply chain costs fluctuate even a tiny bit, your entire profit is wiped out overnight.
Under a normal retail model, you would be 100% correct. But for Costco, that 3% net margin isn't a vulnerability. It's a structural, psychological moat.
Like an exclusive club.
Exactly. They aren't trying to make their real money on the bulk mayonnaise or the TVs. They are practically selling the merchandise at cost. The profit engine of the entire corporation is driven by the membership dues.
It's like they charge you a cover to get in the door, and in exchange, they promise not to gouge you on the products.
Yes, the low margins are proof to the consumer that the membership fee is actually worth it.
And the psychology of that cover charge is fascinating when you look at the retention numbers in the research. The renewal rate is sitting at 89.7%.
Almost 90%.
Yeah, almost 9 out of 10 people are deciding year after year that paying the $60 or $120 upfront is a smart financial move. But, and I have to push back here, just being practical, how does that hold up if the consumer is actually as cash-strapped as Walmart claims?
It's a fair question.
Wouldn't a $120 upfront fee be the very first thing a struggling family cuts from their budget?
You would think so, but it actually becomes a tailwind in a stressed economy.
Really? How does that work?
When household budgets tighten, the perceived value of Costco's pricing promise increases dramatically. We see this well-documented phenomenon called the trade-down effect.
Okay.
So a family that previously shopped at, say, Whole Foods or a premium regional grocer, they start feeling the pinch of inflation. To stretch their dollar, they buy a Costco membership. They trade down in terms of store prestige, but they lock in significantly lower unit prices on staples.
Ah, I see. And once they're in the ecosystem, they see the savings on gas and groceries, and they just get caught in that 89.7% recurring loop.
Exactly. The membership actually functions as an inflation hedge for the consumer.
Wow. And for Costco, the cash flow from those memberships is brilliant because it's collected up front. You pay for the entire year before you even walk through the sliding doors.
It's a massive advantage.
Looking at their balance sheet, that upfront cash has built an absolute fortress. They have $18.9 billion in cash and equivalents against only $5.6 billion in long-term debt.
So a net cash position of over $13 billion.
Which means they're essentially self-funding. They don't have to care what the Fed is doing with interest rates because they don't need to borrow expensive money to fund their operations. That is the ultimate capital protection right there.
That financial independence is exceptionally rare in physical retail. It allows them to aggressively extend their physical footprint while competitors have to pull back due to high borrowing costs.
Right, and speaking of expansion, let's talk about their long-term growth drivers. They are clearly pouring money into growth. The capital expenditures year-to-date are $4.2 billion, which is almost a 20% increase.
That's their existing engine, right? Building more physical warehouses. It's their bread and butter.
But to justify the kind of valuation Costco commands, a company needs a narrative about the future. Where is the next wave of growth coming from? It can't just be pouring more concrete, right?
No, it can't. And that's where the emerging engine comes in. Digital commerce. For years, Costco was heavily criticized by Wall Street for ignoring e-commerce. They wanted to force people into the physical warehouse to create impulse buys.
The famous treasure hunt.
Exactly. But their digital comparable sales just grew 21.5% in the third quarter.
Over 21% growth for a legacy brick-and-mortar retailer is massive. But, e-commerce kind of feels like table stakes today.
Sure.
Expanding digital delivery for big and bulky items is great, but the piece of the research that genuinely threw me, the true optionality here, was the Medicare initiative.
Oh, this is the most exciting part.
The notes detail that Costco is doing a limited Medicare rollout in partnership with Scan Group. Look, I get buying tires, bulk chicken, and a kayak at Costco. But when I think of health insurance, a warehouse club doesn't exactly scream trustworthy medical provider.
I know it sounds wild.
Is this a stroke of genius, or are they wandering way outside their core competency and risking a massive regulatory distraction?
It looks like a bizarre distraction on the surface, but the underlying mechanics are highly strategic. Costco isn't suddenly employing doctors or underwriting insurance risk themselves.
Okay, good. That would be a huge red flag.
Right. Scan Group handles the actuarial math, the compliance, all the medical side. What Costco is doing is leveraging their physical footprint and their captive audience. They're essentially acting as a distribution channel.
Offering Medicare Advantage plans to their members.
Yes, and likely bundling in pharmacy discounts, optical, and hearing center benefits. Services Costco already provides inside the warehouse.
Okay, so they use their existing in-house pharmacy and optometry centers as the physical fulfillment arm for Scan Group's insurance plans. Why does that matter so much to the long-term wealth-building thesis?
Because if it works, it fundamentally changes the narrative of the company. It shifts them from a traditional retailer to a multi-vertical subscription platform.
Wow, okay.
They are targeting seniors, right? A demographic that is growing rapidly, possesses significant wealth, and has highly predictable recurring healthcare needs. If you rely on your Costco membership for your groceries, gas, eyeglasses, prescriptions, and now your Medicare plan.
Leaving the ecosystem becomes virtually impossible. The switching costs for the consumer are just too high.
Exactly. It makes membership so sticky that the 89.7% retention rate could push even higher. They basically become the operating system for a senior citizen's entire life logistics.
That is an incredibly powerful narrative, and it's a narrative with incredibly high margins, right? Which is exactly what they need to offset the low margins of the physical goods.
Precisely. It's
Yeah.
brilliant optionality.
So we have this incredibly durable existing business, a massive cash buffer, and these new high-margin growth engines in digital and healthcare. Yet the stock is still down nearly 15%. At some point, the market has to wake up.
It does.
Looking at the catalyst roadmap and the technicals, what forces the correction? Let's do a technical and sentiment check here.
Well, the technical setup right now is undeniably bearish, which tells us a lot about market psychology. The stock is currently trading below its 20-day, 50-day, and 200-day moving averages.
Which means the trend is broken across the short, medium, and long term.
Right. Every time the stock tries to rally, sellers who are trapped at higher prices use it as an opportunity to exit, which pushes the price right back down.
But the relative strength index, the RSI, is hovering around 40.48. Since the market generally views an RSI under 30 as a sign of extreme panic-selling capitulation, being at 40 suggests we aren't completely washed out yet, right? There isn't maximum fear.
Which implies there could be further downside before we hit a true technical floor. We're in a sort of no man's land where the stock is weak, but not weak enough to trigger algorithmic buy signals.
What about sentiment?
Sentiment is mixed. Mainstream commentators like Jim Cramer remain publicly bullish, which provides some retail support, but the momentum is just grinding lower. We did see one insider sale of 885 shares, but
I mean, for a company with a market cap this size, an 885 share sale is essentially an executive covering a tax bill. That's not a signal of internal panic.
not at all. It's totally administrative.
So the question is, are you the type of investor who waits for the trend to turn, waiting for those moving averages to cross back over, or do you buy when there's blood in the streets and the fundamentals are pristine?
That's the wealth building dilemma.
The reality is, technicals and sentiment only control the wheel for so long. Eventually, the fundamental math takes over, and the math arrives on September 24th, 2026.
Fiscal Q4 earnings. That's the near-term catalyst.
Right. The street is currently looking for $6.56 in earnings per share. This is the binary event that will force the market's hand.
It will definitively prove whether that massive 10.7% revenue jump in July was just an anomaly or if it is the new baseline.
If they crush that 6.56 expectation, we could see a violent relief rally as all this retail sector pessimism gets instantly repriced.
A strong earnings report would absolutely shatter the negative sentiment. It would prove that Costco is immune to the pressures Walmart is warning about.
Here's where it gets really interesting, though, and where my cautious side flares up. Before we start modeling out a massive rally, we have to look at the valuation and expectations.
Always the anchor to reality.
Exactly. The research notes a trailing price-to-earnings ratio of 48.26 and a price-to-sales ratio of 1.45.
And 48 times earnings is a staggering premium for a business that sells physical goods.
Staggering is an understatement. You usually only see tech companies or software-as-a-service platforms trading at those multiples. Buying Costco stock right now at 48 times earnings is like buying a house on the assumption that your salary is going to triple in 5 years.
You're pricing in a flawless future.
Yes, if you get even a slight pay cut, the whole mortgage collapses.
Yeah.
Doesn't Costco have to execute absolutely perfectly just to justify not losing more value?
That is the core friction in the bullish thesis. A 48x multiple assumes software-like margins and infinite scalability. But Costco is bound by physical constraints.
They still have to acquire land, pour concrete, build supply chains, and hire thousands of staff just to grow.
Right. Tech companies have zero marginal costs for software. Costco has massive marginal costs for every single new warehouse they open.
So you're saying the market is essentially mispricing the type of business it is? They're treating it like a tech platform when it still relies on physical logistics.
The market is pricing it as a pure subscription platform, which it is, but it's ignoring the massive physical overhead required to maintain that platform.
Which brings us to what could go wrong. The research rating here is a 7 out of 10, which indicates a bullish stance, but the biggest risk flagged is valuation compression.
That's the real threat.
Let's translate that for everyone. Valuation compression basically means the company's earnings could stay perfectly fine or even grow, but investors simply decide they are no longer willing to pay 48 times those earnings.
They decide they only want to pay 30 times earnings.
Exactly. The narrative changes from unstoppable subscription platform back to really good grocery store. And if the multiple shrinks from 48 to 30, the stock price plummets, even if the underlying business is perfectly healthy.
Precisely. It is a re-rating of the stock's identity.
So what breaks the narrative? What triggers that compression?
Two main threats. First, a true breakdown of the consumer.
Like a deep recession.
Yes. If the macroeconomic environment gets so severe that the trade-down effect fails, meaning people are so broke they can't even afford the upfront membership fee, and they actually start canceling their memberships to save the $60 or $120.
Right. If that 89.7% renewal rate cracks, the entire profit engine of the company is called into question. The moment that retention metric drops, the 48x multiple vanishes.
And the second threat, the new growth engine's failing.
The Medicare stuff.
Yeah, healthcare is notoriously complex, highly politicized, and heavily regulated. If the scan group rollout is mismanaged, or if regulatory hurdles drive up compliance costs, it stops being a high-margin ecosystem play and becomes a massive capital sink.
And at 48 times earnings, the market will severely punish a costly distraction. They do not have the margin of error to experiment and fail.
It's a high-wire act without a net.
Okay, but let's flip it. What is the 3 to 5 year blue sky scenario?
Yeah.
And just to be clear, this is an optimistic look at what the business could become if execution goes perfectly. It is not a prediction.
Right, this is the best-case wealth-building scenario. In 3 to 5 years, if they execute, Costco transitions fully from a warehouse club into a multi-vertical subscription platform.
The healthcare and digital integration works flawlessly.
Exactly. Earnings sustainably outpace revenue because of those high-margin verticals, the membership renewal rate climbs into the low 90s, and the market structurally accepts them as a tech-like lifestyle platform.
Okay, so let's get to the wealth-building verdict, bringing it all back to the core takeaways for you, the listener.
The strongest long-term driver here is undoubtedly that membership moat and the massive cash-rich balance sheet it produces. It's a fundamentally accelerating business.
But the biggest threat is valuation compression. They are battling brutal sector-wide sentiment headwinds, and they are doing it with an incredibly bloated valuation that leaves absolutely zero room for error.
So the base case is they continue steady, durable growth, maybe face some multiple contraction as macro fears play out, but ultimately compound value over the long run.
And the blue sky case is they completely redefine retail logistics and healthcare distribution, justifying that 48x multiple and pushing higher.
Which is why the overall research rating sits at a 7 out of 10. Bullish, but cautious.
The business quality is exceptional, but the price tag demands perfection. The divergence between the dropping stock and the booming sales is going to resolve one way or another, likely starting on September 24th, 2026.
It'll be a defining moment for the sector.
It really will. Just a quick reminder, if you want to run these numbers yourself, the link for the StockOracle 14-day free trial is in the description below.
It's a fantastic resource for this kind of deep research.
Definitely. But as we wrap up, I want to leave you with a final thought, something to chew on that builds on this Medicare integration.
Oh, this is interesting.
If Costco successfully bundles groceries, gas, pharmacy, and health insurance into a single annual membership fee, what industry do they come for next?
Wow.
Auto insurance, mortgages. Are we watching the evolution of a warehouse store into the ultimate lifestyle operating system for the American consumer? Because if they pull this off, the traditional boundaries of retail are gone.
That is a wild thought to end on.
Something to consider for the long-term portfolio. Until next time, keep compounding, and thanks for joining us on this deep dive.